Welcome to TheoTrade. This is Don Kaufman doing the weekend update here on March 4th, 2017. First and foremost, I'm going to give you a quick review, kind of a week in review. Then we're going to be very forward-looking as we typically are, give you a couple of trade ideas for this coming week of trade. And moreover, we're going to talk about markets in general, of course, hitting all-time highs. So let's get right into it here. Midweek, of course, after the presidential speech on Tuesday night, the S&Ps crack into all-time high. Now, again, we've been mentioning that week in and week out, all-time high. And it's becoming kind of Groundhog's Day out there, right? Well, the S&Ps crack into the 2,400 range this week. And throughout the course of the week, all I'm hearing about is this rally and that rally and how dramatic the rally happened to be over there. But let's put this into a little bit more what I would term quantitative perspective. And what I try to do each and every weekend, for those of you that do tune in here to TheoTrade on kind of a week-to-week basis, especially on the weekend updates here, I look at it kind of quantitatively. What was the SPX expecting? And for that, on thinkorswim, I go to the Analyze tab. I'm going to close up this left side bar and just review the week. Again, today's date is March 4th. What I've actually done here on thinkorswim is I've backed up the date, okay, over here to February 26th. So I just backed it up to last, Sunday over there. Neither here nor there. But the reason I'm doing that is I want you to see, number one, where the market ultimately was, okay? So the market started out the week at 23.67, and that the market was ultimately expecting just under a $24 move. Now, I referenced this on Wednesday directly after the rally because the market exploded higher Wednesday, and I actually referenced this expected move. And I talked about it in quite some detail. And for those of you that don't remember, what I often do is, well, we realize that the market exploded higher, okay? But again, when you look at an expected move, it doesn't tell you whether we're going to go higher or lower, okay? But it's a great exercise during the course of the week to look back and see what was the entire week expecting. And let me just reference this again because I think it'll make you much better at understanding where your risk lies. So we'll take 23, ultimately 67, and just add $24 to it. Okay, comes out to $23.91. So as the week was progressing, now we'll look back over to the chart. As the week was progressing, we clearly cracked above $23.91. Now, these expected moves, they don't say that you can't crack above a particular level. And I like to always make that abundantly clear. It's a probability of expiring inside of a certain range. The reason the SPX expected move for the week, the reason it carries so much weight is just the sheer activity. And what trading firms are ultimately doing today is that these trading firms, first of all, they're trading the SPX massively. Okay, we know that because the SPX is doing well north of 1 million contracts a day. And, you can always look at, how much did the SPX actually trade in a given day? Well, here's the SPX yesterday, which was Friday's, 1.35 million contracts. Yet the entire options market only did 17 million contracts. And the SPX contract, okay, is like 30 times larger than the average contract. It's a $2,400 product. So there's this massive liquidity moving in the SPX. And if you understand what the trading firms do, what does a trading firm do? Most of the trading firms trade what's termed net neutral. They're not taking big directional positions. That's actually part of the Dodd-Frank bill. If you're a too big to fail firm, they're supposed to only use what's called bona fide hedging activity, right? And I don't want to get too much into the regulation side, but if you get what that means, basically, as the market moves, okay, these firms just kind of hedge with the motion of the market. If the market goes up, okay, if the firm ultimately is long or short gamma, they're just buying or selling futures against their SPX positions. It's just hedging activity. Now, the hedging activity going on relies very, very much on these expected moves. Why? Because the expected move is really, okay, that's the risk parameter. That's what the implied volatility kind of denotes. And again, this gets kind of quantitative, and I've talked a lot about expected moves in a lot of different videos, okay? However, when you look at the $24, you have to recognize there are literally billions of dollars resting on that expected move, because every option in this chain, okay, what it's doing is pricing to a $24 expected move for the entire week. All right, so if they've actually traded in here, they're basically trading in and around the expected move, which causes hedging activity to bring markets very often inside of these expected moves. So the moment that we cracked midweek above 23.91 on Wednesday, in the video that evening, I said markets are very likely to come in, meaning that when the market actually cracked above it, it was at 2,400, didn't close there. The market actually closed just north of 23.91. And I said specifically on Thursday morning, we're very likely to open right in and around 23.91. That's where the risk lies and kind of come in. But overall, I also want to state, okay, if you looked at this trading week, let's just allow this to kind of resonate with you. The week ultimately started at 23.67, right? So it ended at 23.83. This isn't like a big, huge, explosive rally. And remember, the expected move doesn't say we're going to move $24. It says we're likely to move in $24 range. This is a big, huge, explosive rally? Absolutely not. From, a couple of bucks over here? Again, we're splitting hairs, but this is not like this drastic rally. So we did come in quite nicely from that 23.91 level and ended the week well inside what was expected. We saw 23.91 was expected. We only came in at 23.83, so well inside the expected move. All right, now, the reason I'm also bringing up the expected move, last week with the presidential speech, there was a little extra oomph being priced in here, right? It's about almost a $24 move. Well, now let's be a little bit more forward-looking, okay? And being forward-looking, now we're actually looking out to, next week. If you look at next week, the expiration next week, all right? So we have a Monday expiration, a Wednesday expiration, a Friday expiration. It's exciting, a Monday, Wednesday, and a Friday. But allow this to kind of sink in over here. We're under a $20 expected move. Now, why is that a little bit crazy? From where I sit, there's also there's still a jobs number to come out next week. There's actually, all kinds of news that's going to infiltrate the market. They're not pricing anything in. There's just no risk being priced in. And it's something that should really sit with you because, you thought last week was kind of crazy, 1 or 2 days over there. But, the market's moving around quite a bit. But the expected move by the end of the week it's in a very, very narrow range. So remember, there's only about a $20 movement, which takes us, for the most part, right up to about 2,400 or down to about 2,360. Now, I want one other idea to kind of infiltrate to you, and that's this. Lately, okay, here's just again, a distribution curve. And here we are at roughly 23.80. I'm just rounding it. So we're expecting plus $20, okay, or minus $20 in the S&Ps. And we're supposed to stay in that range approximately 68% of the time. Now, this is just a 1 standard deviation move. But the irony is, lately, okay, the markets have not been in this range 68% of the time. The markets have actually been in the 1 deviation range, okay, above 85% of the time. And the craziest part, though, of this, okay, is when the markets crack the expected move, and this expected move is up or down $20, when they've been doing it lately, which is very, very infrequent, they've been doing almost 3 times what was expected. So all of a sudden you're thinking about this we're likely not to do anything this coming week. But if we're going to do something, you can almost expect a $60 move. And that's something, again, I want it to resonate with you because if you look at the SPX chart, now I'm actually going to bring up a 1-year chart over here. Nothingness followed by what we term 3 deviation move. Nothingness, 3 deviation move. Actually, ironically, this latest move to the upside, this has actually been very, very orderly. And almost every single move we've seen lately has been right on the edge or the cusp of the expected move. This move has not been a 3 deviation move in any 1 week. However, the last one that really sits with me was in December. Okay, was actually right there. It was December 7th. It was Pearl Harbor Day. This was the last real 3 sigma move that we had. That was a 3 standard deviation. We moved 3 times what was expected over there. Okay, the reason I'm mentioning that right there, that 3 deviation threat is why I'm not selling premium. Because that's all we've seen lately. Nothing is followed by 3 deviation. And if you sell options premium, okay, you make money, run over like a freight train. You're like, oh, I didn't even see that one coming. Okay, so I wanted to get to the weekend review and be very forward-looking. And the forward-looking portion of this is, oh my, the volatility's low, okay? I'm going to be a net buyer of premium. I've been long gamma. I've been making money doing these buy and bail straddles that we've talked about quite frequently here in these evening videos and weekend videos. It's just buying a straddle or strangle, literally, and bailing out of it once I've made money on one side or the other. And it's been extremely effective. It was incredibly effective last week. All we needed is, Wednesday and a 30-point move in the S&Ps, okay? And why I'm saying this is, so last week we had a 30-point move in the S&Ps. This entire week, and I'm not necessarily saying go out and buy yourself a straddle or strangle, but you can buy a strangle for $15 for an entire week. We had a 30-point move last week in 1 day. All right, you buy something $15, the market explodes by 30, you're a winner. Just something to think about. That's why I'm not selling premium right now. And I always like to state, I made my career selling premium, and I really don't want to sell premium. Now, before I go into a specific trade, because we're going to talk about bonds momentarily, before I go into a trade, I don't often get into psychology of markets, but I am going to state this, okay? If you're an investor, you've been holding markets now, hopefully for a long period of time, and it's not half bad. When I say an investor, that's just, somebody that's gone out there and bought and hold, and, all right, you're in it for the long haul. When is the long haul over? When you got 1 foot in the grave or both feet in the grave? But you've been in it for the long haul, and you've done quite well. This market right now is going to torture each and every one of us, whether you're an investor, whether you're a trader. If you're a trader, okay, you have to sit there and fret on a day-to-day basis. Should I be long? Should I be short? It's kind of difficult, right? It's one of the reasons I'm going out there and buying a straddle or strangle. It's because, again, I have short positions. Make no 2 ways about it. You go to my monitor tab and I'm short, a couple of these, couple of those, couple of these, and a partridge in a pear tree over there, right? I'm short. Not easy to sustain them. The market right now looks tired, but back away. Listen to me. You don't need any technicals. You don't need any fundamentals. There are no fundamentals. The entire market is being driven by stock buyback, right? So forget fundamentals out there. You want to hit earnings per share? Buy your own stock. It's financial engineering at its greatest. Low interest rate, okay, has fueled the capability for companies to go out there and just borrow capital in inordinate amounts. Buy your own stock. It's brilliant. If you're going to be CEO for the next 6 years, that should basically be your mantra. I will buy my own stock and buy myself into retirement. Yes, I'm being a little bit sarcastic, but that's literally what's going on. But with that, it's going to torture you in terms of, what do you want to do directionally? There's going to be those that believe we're going to explode higher. Sure, we could. There's going to be a lot of those that are, no. We're still very, very bearish out there. So the market right now looks tired. And then when I say this is when it's going to torture you, this is very reminiscent of a couple of positions that I've been in over the years. And, you always remember where you're just picking a direction in a marketplace like this, it's almost like futility. So mitigate the risk. Okay. Listen, I'm not here to tell you whether to be bullish or bearish. Okay. I pretty much wear my position right up there on my shoulder like I'm bearish. I've been bearish for a long time because it looks like the market has just been engineered, of course, higher based on low interest rates. So the interest rate environment is rising. However, I'll come to that in just a moment. At this point in time, okay, one of the things that you have to, it's really got to soak in, whatever risk that you take, okay, you have to not only take that risk on, okay, you have to be intimately comfortable with whatever that risk is. And I want you to think about whatever amount of risk, what you're called your delta, Okay, take your delta and compare it to like what's the market going to do over the next, for instance, 30 days. So the market's pricing like almost a $60 expected move. All right, almost a $60 expected move over the next 30 days. Take that number and triple it. Because again, we've seen so many like 3 deviation moves in the past couple of years. Just take it and triple it. And you're like, well, that's a huge move. I mean, again, you start getting up to like close to like, 200-point move in the SPX in the next 30 days. It should scare you. And that could be to the upside or to the downside. And that's just one of the ways I want you to be able to evaluate your risk, because you have to take that psychology out of play for yourself, right? Don't torture yourself right now. You think, and listen, nobody has any clue as to what this future holds. We're one catalyst away, all right, from being down 200, and clearly, okay, we're one catalyst away from being up, another 200 points in the S&Ps over there. And again, I've been doing this for enough years that I can say there is nobody that's going to have a great feel for a marketplace, okay, that has moved already at this point 300 S&P points to the upside in a matter just of a few months, okay? So again, in every sell-off, and if you're looking at this, you're going to have a lot of traders in every sell-off. They're going to come in here and they're going to buy the dip. All right. We already know that because in every sell-off, we've seen that lately. So you're going to get these dip buyers. This could actually go on for a period of time. We could vault higher. We'll drop out. They'll buy the dip over there. We'll vault higher, drop out. Unfortunately, one day we'll just drop out and keep on going. That's what's going to torture those that are long. Those that are short, you're going to get squeezed into an oblivion right now. It's all about comfortability of risk. If you can't sustain the position, okay, you're not going to live through it. And you really have to be thinking, you got to be able to hold for the duration to be directionally correct. So think about that a little bit. Now, on to the bond market. Okay, one of the last things I want to talk about kind of on this update here is a bit about the bond market. Now, again, here I really do have a very definitive opinion. When the whole world is looking at the chance of interest rates going up, and we're going to have an FOMC meeting coming up in 2 weeks, okay? The whole world thinks that the interest rates are going to be raised, right? When I say the whole world, there's an 80% probability now of the Fed raising rates. This is not going to impact, like when we look at bonds, this is the 30-year, or the ZN, which is the 10-year, okay? I actually believe that these products are going to go higher, which takes interest rates ultimately lower. So I'm a little bit the naysayer, a bit of a contrarian on the bonds. Again, I do believe that the bonds, and I love to draw it on the chart, I believe the bonds are still going higher. Maybe one last hurrah into the 158 territory in the bond product. Why? Okay. Why do I believe that the bonds are going to go higher? Now, again, bonds higher would actually take the interest rate associated with this lower. So I'm telling you, interest rates, I don't think they're going to go up. I think they're actually going to go down a little bit. Why? You still have a huge portion, okay, of the first world nations that have negative interest rates out there. Okay. There are still trillions and trillions of dollars of negative interest rates. And the moment that our interest rates start to go up, those other countries will turn around and they'll just dump capital into the US. It's a great, what they term arbitrage. If you can borrow capital for nothing or even get paid to borrow capital, right? Negative interest rates is actually getting paid to borrow capital. But think about this. You just borrow capital for nothing and stick it over in the United States. Those guys over there are going to pay like 2-3%. Beautiful. Like seriously. All right. That's why, okay, the moment our interest rates, you can look at the 10-year. This is the 10-year interest rate. It's sitting about 2.5%. But the moment they can actually borrow capital and then just dump it into the U.S., treasuries and make yield 2.5%, beautiful. They'll continue to do that. And that's why I still think there's a glut of capital that's going to come back towards the bonds. As such, I'm looking for a position inside of the TLT. And I'm going to be looking for a bullish position. I'll update you a little bit on Monday on the bullish position that I'm looking for in the TLT. Again, at this point in time, one of the most important things that you can do, don't worry so much about individual stocks. Like, I'm already all Snapchatted out this week. I got so many emails about Snapchat. And what do you want to say about a stock like this? You can either buy it or you can buy it. There's no options listed yet. Yeah, they'll list some options in due time, but the options market's not going to be vastly liquid in here. All right. If anything, if you look at something like Snap, first of all, 85% of all IPOs don't even see their initial public offering price, okay? Meaning that they fall very quickly below their IPO price. In the case of Snap, it was 17. That's neither here nor there. My own belief on Snap, it doesn't matter. But when you look at a company that's rallying, 30, 40, 50% right after the IPO, you do have to step back from markets and go, listen, is this market maybe a little heated over there? And really, Snap, it's iconic of what you've seen in previous markets that were almost bubble-like. That's, again, another portion of the psychology out there for you. With that, again, I'll be back on Monday to give you an update there on that TLT trade that we will build together. Thanks, everybody, for joining me this weekend. Have a great weekend. Bye-bye.